can or think you can't, you're right. And the basic premise of that is, if you believe you can buy a house, you can. If you don't think you can buy one, well, you can't. You're going to be right based off what your thought process is. And I can tell you for a fact, there are people that sat in those chairs this time last year that woke up this Saturday morning, by the grace of God, in their own homes. And they were sitting in those exact same chairs. Well, we did a different location last year. So they were sitting in the exact same position as what you were in. And what you have to do is, that little voice is talking and chirping right now. Everybody's already decided whether they like me or dislike me. They've already formed their opinions on whether I can do business with them or not. And that little voice right now is talking and everybody is on your shoulder. You want to kick it off. Because again, if you decided that this is what you want to do, and you know what your why is, okay, you got to kick that voice and that little man or whatever off of your shoulder, whispering to you that you can't do this, because you can't. Home ownership is one of the ways that we can make a difference. Buying property and paying real estate taxes are how we get better schools in our community, how we get police in our community, how we get better roads in our community, how we get better libraries with new computers in our communities. Owning real estate is the key to you being able to establish and build wealth and legacy for your families. Now, the other part of that is that certain demographics have been taught over the years how to be consumers and not owners. Everybody does understand the difference with that, right? They've taught us very well to be conditioned on how we can afford that furniture by the small monthly payment of $25 a month for 5 or 6 or 7 or 8, 9 years. So by the time you get to the end, that bedroom set, which was $500, you paid $5,000 for it. We've been conditioned on how to be consumers versus own. Consume versus own. So one of the things that we want to focus on is really changing your mindset and determining today, what is your why? Why do you want to purchase a home? Don't make it an emotional decision, because if it's an emotional and it's based off just your feelings, when you get into the process and the work starts, if you don't feel like it that day, you might not work towards your goal. But if it's a decision that you've made and determined my why is going to be, I'm going to break the cycle of everybody in my family being renters and nobody's own. I'm going to show my kids that mom and dad can buy something and own it, and they're going to want to be able to buy homes when they grow up. When you leave here, instead of leaving the kids that old Cadillac that was clean, you can leave them a piece of property. So what we have to do is we have to start thinking about wealth, legacy, ownership versus consuming. So this is the place. So if your goal wasn't to figure out how to really buy a house, this isn't the place for you. Because what we're going to do is we're going to pull the curtain back, and I'm going to tell you specifically what we need to do in order to make it happen. First thing, you guys see in there in bold letters that I have, budget, budget, budget. So let me say this. Antoinette, Tiffany, and Tracy get the fun part. They get to talk about bedrooms, backyards, bay windows, the color of the kitchen, the appliances, stainless steel, all that other stuff. I talk about the money. Because if you can't get the money, you can't get the house. Now, when I say what your number is, you know what your finances look like. You know how much money you make. You know how much that direct deposit is that hits the account. You know what family member you might have to hold a little bit to the side to because you have to help them every now and then. I can still do straight talk, right? See, when you come to the bank The bank doesn't know you might have to send grandma $50 on her light bill every now and then. Right? So, you have to determine what your number is based off an honest look at what your finances are. And then you have to say, based off my finances and the obligations that I have to meet, I can afford to pay this amount for a mortgage payment. If you go into the bank and you let the bank, us, tell you how much you can qualify for the house, you already starting this transaction off completely wrong. Because our job is to lend money. Everybody knows that, right? Our job is to lend money and charge you what for that money? That's what the bank is in the business of. So when you come to me, and our job is to lend money and earn interest off that money, aren't we trying to lend you the most money we possibly can? Right? So if you come to me and I tell you that based off paper, you qualify for a $1,300 mortgage payment, and we go and buy a house that gives you a $1,300 mortgage payment, but you've known all along that you know you can't go past $900, we have a problem, right? I get that question asked 3 or 4 times, 5 times, almost every single day. I always start off, what's your comfort level as far as a monthly mortgage payment? That's what I ask. And they, 9 times out of 10, they come back and say, well, how much do I qualify for? And I light it to them every time. Because that's the first step. Because this is what's going to happen. Remember I told you about those emotions? When you get out there and start looking at houses, and they start showing you them backyards and bay windows, and that nice stainless steel kitchen that you really want, those are the feelings. Those are the emotions of it. You thinking about all of this stuff. Well, what's going to happen is, you're going to get in that house, you're going to have your housewarming party, you're going to post it all over social media, and you're going to be really, really happy. And then what's going to happen is, one day you're going to be driving in from work, and you're going to stop at that mailbox, and you're going to open up that mailbox, and what y'all think is going to be in there for you? You don't want to be surprised. You already want to know ahead of time what that payment was going to be before you even get out there. So you have to establish budget first. Then what we're going to do is tell you what's the most house that you can buy and still stay within that budget. So when one of the real estate professionals in the room take you out to look at homes, you're going to look at homes that are going to give you the payment that you decided that you want. So after closing, when you stop at that mailbox and open it up, there's no surprises. Because you determine what monthly mortgage payment you want. Hold yourself accountable. Discipline equals freedom. Probably sound like a broken record. Discipline equals freedom. Discipline with your finances is going to give you freedom on the back end. Pre-qualification versus pre-approval. This is big. Number 1, pre-qualification is verbal only. Verbal only. Nothing is verified, and it's inaccurate information. This team does not do pre-qualification. Okay? Pre-qualification is this. You call me on the phone. Hello? I want to be pre-qualified for a mortgage, okay? How much money do you make? Make $3,000 a month, okay? What are your bills? $500 a month. Okay. How long have you been on your job? I've been there 2 years. Okay. Based off this, you qualify for $175,000. Go on out there and find a house. Okay, cool. Now, the problem is that when you go in and you're just doing a pre-qualification and nothing is verified, then when you go and find the house and it's time to see if you really are able to get it, then we have to check the stuff that you talked about. And you told the guy that you made $3,000, but you added your bonus and your commission that you get in, but you only been on that job in the commission position for 2 months, and then you forgot to ask about your child support that you did, blah, blah, blah. You get into all of these other things that could take that verbal non-accurate, non-verified information and shoot you in the toe. What we do is pre-approval. Pre-approval, number 2, specific information, verified information, accurate information. Specific, verified, accurate. I want to know, I don't want to hear $3,000 a month. I want to know, are you paid on salary? Do you get a bonus? Do you get commission? Is that overtime? Is that shift differential? How long have you been in that job? Have you changed careers? I have to look at your credit. I have to look at every single piece of your financial situation so that when you find the house that you like, all of that stuff has been verified. Pre-qualified, bad. Pre-approval is what we do. So when we get started, it's going to be work. Because I'm going to dig deep into your finances and your credit and everything else. Because I want to make sure that your loan can be done before you go out there and fall in love with the house. Next piece, the components of your mortgage loan application. There's 4 pieces to it. Income is number 1. Employment is number 2. Assets, number 3. Credit, number 4. Income, employment, assets, credit. Think about the 4 corners of the new house that you want to buy. When you come in and you speak to the lender, those are the 4 pieces that we're looking at. Start with number 1, income. We need to see that your income has been consistent. If you start a new job and you're happy and you're excited about it and you got a raise and for the last 3 weeks they've been giving you extra 10 hours in overtime and the check's looking real good, we can't use that overtime income until it's been established over a period of time. We need to see that your income is stable. 2 things that prove stability. 1, we're going to look at your income history. 2, we're going to look for what's called likelihood to continue. So, if you have a history of working, that's good. And that also means you're likely to continue working. Now, if you don't have a history of working, it's reasonable for us to assume that you may not likely continue to work. So the income is all about history and likelihood to continue. Employment. One of the biggest myths out there is that you have to be on one job 2 years. Not true. Okay? So the next time you hear somebody say that, it's not true. What we want to do is look at your 2-year history. And we want to see that you've been getting up and going to somebody's job every day for the last 2 years. That's what we're looking at. Now, let me also say, you can't be changing jobs every other week either. Okay? You ain't have a crazy boss every single time. You know, sometimes we have to hold some accountability with it. Now, it may be 1 or 2, but so if you've had more than 3 jobs in the last year, we're going to look at that kind of sideways. But let me tell you this. Generally speaking, if we as the bank can determine that you can pay us back our money plus interest, we giving you the loan. Okay? So, we're looking at ways to be able to make your income work, not look at a way to say, I don't want to do it. Does that make sense? So that's another mindset thing. Sometimes we get conditioned with, oh, they didn't want to give me the money. Yeah, we do. Yeah, we do. I want to approve everybody in this room for a loan. No questions asked. So again, that mentality thing just makes sure we have that checked as well in that regard. The bank wants to lend you the money because we want your interest. We really don't have anything to do with whether we like you or dislike you, but what we do like for a fact is the interest. Right? Assets. This one is always a little sticky because a lot of times the client will ask me, well, how much money do I need to have? You know, how much money do I need to have in the bank? How much do I need to have this? How much do I have that? It is going to be different based off everybody's situation in this room. Some people are first-time home buyers and may be able to get a grant and do a 0-down loan. Some people may have to do a small down payment. Some people may want to do a big down payment. Some people may have this credit score, that credit score. The amount of assets that you have is going to be different based off everybody. But this is what I can tell you. The bank is going to want to see that you're responsible with your finances. That's why we want to see a bank account. Another thing that we look at a lot, your retirement, your 401k. Anybody in here whose company is offering a 401k, you need to sign up for it. Now, I know it's in the news right now, they're doing some changes and this, that, and the other, but at the end of the day, the way that they have set up for you to be able to save money pre-tax and then your employer matches it, it is one of the biggest ways that people are accumulating wealth. Fourth piece, credit. We are going to look at your credit. You do not have to have perfect credit. We could almost spend the whole talk today on credit, but we're not going to do that because prayerfully I'm going to be able to have an individual meeting with you guys all later, and we'll talk about that when we get to the end. We do not need perfect credit. What we're doing is we're looking for responsible credit. Okay? Now, that credit is a really sticky thing. Okay? We're really looking at your credit history. Our history doesn't completely define everything, but what our history does is show us what's likely to happen. Right? Whether it's good or bad. You know friends, family members, co-workers, managers, everybody, you have a pretty good idea of what they're going to do based off what they've done. Okay? Now, the good thing about credit is we can fix it, we can change it. We can draw the line in the sand today and say, you know what, regardless of what's happened the last 2 years, this is what we can do from today going forward so that we can get ourselves a better picture for the bank. Credit is big. Your credit score does not define who you are as a person or an individual. The only thing your credit score does is says what your payment history has been and what's likely going to happen. That's all a credit score is. A credit score is looking at your history. They put it through a credit scoring formula or algorithm, and based off your history, they determine whether you're likely to pay something in the future. Now, there's over 70 versions of the FICO score. So, I get this question a lot, so I'm going to answer it before it comes up. Whether you're going to get a car loan, a credit card, a mortgage, a student loan, utility, cell phone, there's a different credit scoring formula or algorithm based off of the type of credit that you're pursuing. So, when you come in and you go to somewhere like Credit Karma and you pull the credit, they don't know what type of credit specifically you're going for. So what they're doing is they're giving you a general credit scoring formula and algorithm that's just giving you a real big, broad, general score. When you come to a mortgage bank, we're pulling a retail mortgage credit report, or RMCR, that's specific to mortgage. So when you go to a lot of those consumer sites that are out there, and they give you one score, and then I pull it and it's a different score, I'm not saying that their score is wrong. What I'm saying is their score is not relevant to you getting a mortgage. So they're good for letting you know what your trend is. So let's say you pull Credit Karma and you're at a 580, you go to working, you go up to a 610, you go up to a 630, you go up to a 650, you go up to a 700. It's letting you know that your score is trending upward, which is good, although it may not be telling you exactly what the score is right now. So the credit piece is really, really big. And what I want to tell you is what your credit history and score was before, it is not relevant to me. I don't care. Okay? If your credit is good, I'm going to say, okay, this is what we do next. If your credit needs some work, I'm going to say, okay, this is what we need to do next. It's not a matter of if you can buy the house, it's just a matter of when you're going to be able to buy the house. Next piece of it, the 3 C's of your mortgage underwriting. Okay? 3 C's. Number 1 is capacity. Number 2 is credit. Number 3 is collateral. So write down capacity, credit, collateral. The first one is big. There's a thing that we're going to refer to as debt to income ratio, or DTI. Debt to income ratio, or DTI. This is big. Okay? This goes back to your budget. When the bank determines how much house you can buy, we do it off your gross income before taxes. So, when you come to the bank and you say that you want to buy a house and you make $4,000 a month, we're doing all our numbers based off of $4,000 a month. Everybody knows in here that if you make $4,000 a month gross, you're not bringing home $4,000 a month. You may be bringing home $3,000 a month. So, right off the bat, it's a flawed system of banking. Set up for those who don't understand what's going on to borrow more than they can afford. Because if I'm telling you what you can afford based off $4,000 a month, but you only bring it home $3,000 a month, we have a problem. That's why you have to determine what your number is, because you need to determine your budget based off of your net, not the bank telling you what you can afford based off of your gross. So capacity, your ability to pay. We want to make sure whatever you're borrowing, you have enough money to show us that you're able to pay it. You may have good credit scores. You may have stable income. You may have all of those things. But if your income is $3,000 a month and your bills are $3,000 a month, the bank is going to say no. Because we want your bills not to exceed a certain percentage of what your income is. So capacity, do you have the ability to pay? Credit, do you have the intent to pay? Next piece, collateral. This is another big deal. If you don't pay, we're taking the house. But we don't want the house. We do not want the house. What do we want? We want the interest. So a lot of times I talk to clients and they have the mindset of, well, I mean, if I don't pay it, you just take the house back. We don't want the house. We want the money and the interest. Last piece, loan programs. There's basically 5 loan programs that we focus on. Do I have any veterans in here? Anybody active duty or just 1? Thank you for your service. 2, yes sir. VA loan is the best loan on the planet. 0 down, no PMI, low fixed rates. If you have VA eligibility, that's the way to go, no questions asked. Okay? Those of you who do not have VA eligibility, first-time homebuyer program is number 1. It's a big one. They just recently changed it. It was you can get up to $15,000, now it's $7,500. You can get up to $7,500 that can be used for down payment and closing costs. Couple criteria, you have to be a first-time home buyer. First-time home buyers consider anyone who's not owned a home within the last 3 years. So if you had a home before and you sold it, lost it, whatever the case may be, as long as you have not owned a home within the last 3 years, you're eligible to be a first-time home buyer again. Down payment assistance grant money is available to you. FHA loan is another popular one. The reason that the FHA loan is popular is because it has reduced credit guidelines. So for instance, the first time home buyer program requires you to have a 640. If you do FHA, you're only required to do a 600. So if you don't have the 640 credit score, but you can come up with a little bit of money from a down payment, like from your tax refund or 401k or your savings or a gift for a family member, instead of you having to wait to get to the 640, you can go sooner and just buy your house with just a 600. Okay? Conventional loan is with as little as 3% down. Conventional loan is also a fixed rate. There's some pros and cons between FHA and conventional that I won't really get into right now. but it's just another product that's out there that could potentially help you. Generally speaking, it's a little bit tougher to get the conventional loan approved, but the terms are a little bit better than FHA on certain things, like with your private mortgage insurance and stuff like that. Okay. The next one is a USDA loan. That loan is a zero down loan, but it's set for rural areas. So if you're trying to get to certain parts of Oakley, well, not even Oakley so much now, but when you start getting into McClenny and Callahan and some of the places that are a little bit farther out that's considered rural areas, you could potentially go zero down again and use a USDA loan. So it's not as popular if you're going to be around town, but if you're going to get out a little bit, it's something that we would definitely look at. Or let me clarify. There is no such thing as a first-time homebuyer loan. It's a first-time homebuyer program. You're still going to get either a conventional loan or an FHA loan. The only thing that's happening is the first-time homebuyer program is giving you down payment assistance. So on an FHA loan, you need 3.5% down. So instead of you coming up with your own 3.5% down, the first-time homebuyer program gives you the 3.5% down, and you're good to go. Okay? So those are all of the programs. Also, I want you to write this down. www.applywithwillie.com. www.applywithwillie.com. And Willie's W-I-L-L-I-E. So what I'm going to do is everybody that's attending the seminar is going to get a free 30-minute one-on-one consultation and also a free credit report, no matter what side of the street you land on. If you're good to go, we're going to give you a game plan. If you're not good to go, we're going to do a game plan. And your free credit report is sponsored by our real estate professionals here today.